So today we're going to get into monetary policy. So we've sort of built up a model of aggregate demand and aggregate supply. We've talked about fiscal policy. And today we're going to get into monetary policy, which is the other type of aggregate demand management. And so monetary policy, in a nutshell, is the use of the Federal Reserve and its control on the supply of money to manage aggregate demand. Okay, and so what we're going to do is I'm going to show you how we can use the Federal Reserve and specifically its control on the supply of money to sort of move aggregate demand around and cut short business cycles. Right, and again, this is a theoretical thing. We're not going to say that it perfectly matches the world, but it is one of the ways that government attempts to resolve or prevent or cut short business cycles today. And so it behooves us to understand what it is that they're doing and what it is that they hope each one of these things will accomplish. Okay, but in order to do this, we have to develop an understanding of a few things. Now, a guy named John Maynard Keynes wrote a book in 1936 called The General Theory of Employment, Interest, and Money. Okay? Now, what was going on in 1936, right? It was the Great Depression, right? It was also, I think, the year my grandparents were born, but I could be mistaken in that. In fact, I am mistaken in that, so disregard that one. It was, however, the Great Depression, okay? And so it's clear, if you read his book, that this has, influenced his theory a great deal. Okay, and what we're going to do is I'm going to explain his theory of liquidity preference. Okay, so it's the theory of liquidity preference. Okay, and the basic idea here is that interest rates adjust to balance the supply of money and the demand for money. Okay, and this sounds somewhat interesting, right? The supply of money is a fairly easy thing to wrap our head around, but what is the demand for money? Okay, so let's go through these things real quick. So the supply of money, like we've talked about before, is just the number of dollars in an economy, and we can count it using M1, M2, or M3, just like we talked about a few lessons ago. And so what we have is on the graph, or on this graph, we would have R, which is the interest rate, and Q, where Q is the quantity of dollars. Okay, and what we say is that the number of dollars that exists is not a function of the interest rate, right? So it's just a vertical line at, let's say, Q1, right? And this just says that there are this many dollars in the economy, okay? And what the Federal Reserve can do is shift this curve left and right as they need to, okay? And so let's go through sort of how the Federal Reserve does this, okay? Now, we should note that banks today use this idea of fractional reserve banking. Okay, and what fractional reserve banking is it's the idea that banks only keep a certain percentage of dollars on hand, or let's do that more accurately, of deposits on hand. Okay, so when you deposit, let's say $1,000 in the bank, they might only keep, let's say, $500 of that, and they'll loan the other 500 out. Okay, now this isn't too big of a problem because most of us aren't running around trying to take all of our money out of the bank at once. But if we did, if everyone tried to take all of their dollars out of the bank, out of all the banks at once, that would be sort of a problem. In fact, it wouldn't sort of be a problem, it would be a complete problem because there would not be enough money to do so. Okay, and so this is where the Federal Reserve comes in. It was established in 1913. Okay, and it's made up of 12 member banks and one sort of chair head Federal Reserve Bank. And technically it's owned by commercial banks that are its members, but to become the Fed chairman or the Fed chairperson, you have to be appointed by the president and then confirmed by the Senate. Right? So the current Fed chairman is a woman named Janet Yellen. Right? So she was appointed by President Obama and then confirmed by the Senate. Okay. Now, what we have is a system or a organization or a Federal Reserve that, like I said, moves this along and sort of exists to make sure that banks have the necessary amount of money. Okay, and the way that they can do this, the way that they can affect, whoops, my pen is evidently running out, which I've never had happen before. What the Fed can do is they can use one of these three tools. Okay, so I'm going to list them out and then I'll pull out a new sheet and we'll go through this. Okay, so the first one is what we call the Reserve Requirement Ratio. The second one is what we call the discount rate. And the third one, or sometimes known as the Fed funds rate. And the third one are open market operations. Okay, so we'll stop this video here.